You know what? I forgot I have to transfer the CPA scores. I'll go do that tomorrow. I forgot I have to transfer them.
Hey, well, there you go. It works out for everybody.
Yeah, the first time I tried using them, and I just forgot I had to transfer them. Let me grab a sheet of paper. I just totally forgot about that. And the gradebook isn't set up, and I need to rearrange the columns the way they are in the gradebook. And so I didn't notice it. Okay, so if you did poorly on the quiz, I will replace your lowest quiz grade with your final exam grade. That's not always a benefit. So, I mean, I won't replace it, obviously, if it's worse. What I meant by it's not always a benefit is that the final exam grade isn't always the highest grade.
Yeah, that's true.
But sometimes it is. So, you know, if you study hard and you make up the stuff that you didn't know. So, how much time have you guys spent on Chapter 5 so far, revenue recognition?
Not much. I spent about an hour on it.
I'm working on the part 2 of the practice exercises.
Okay. So I want to like go through it really quickly, which I haven't done before, but I want to kind of coach you on how to organize the thinking. And the other thing I want to do is I want to point out, like I looked at this and I'm like, oh, great. There's only one chapter. What am I going to do all week? And then I realized how much is in the chapter. And it's like, okay, now I know what I'm going to do all week. So I want to go through, just like quickly go through some of the concepts before we work problems. And I also want to help you relate, like I usually couldn't pull this together until intermediate 2 or 3, but revenue recognition is a really good point. You start seeing how some of those rules that you already know apply. And of course, revenue recognition has completely changed, but the basic premise hasn't. And so that's what I'm going to show you. All right, before we do that, let's talk about the paper. Everybody should have submitted a topic for the paper. So if you don't have a topic submitted for the paper, you need to do that. So are there any questions about the paper? Let's start with the library. Does everybody know how to go in and use the library?
I never used it before.
Okay.
I'm
So
just stuck with timing is the problem that I'm having right now. So I'd already asked my boss for a half day on Friday so that I could work on that on Friday and Saturday.
okay. So let's look at this. So here's the instructions for the research paper. I didn't catch that she has single space. I'd rather it be double space, but I'm not going to take off for single space because it's obviously written here. You have to have 5 full text articles. See it in bold? 5 full text articles. And a minimum of 3 should come from well-known business or accounting journals. So the biggest point of this entire assignment is to get you to use the library, because you're early on in your program, and the sooner you know how to use the online library, the better you're going to do with your whole academic career. So I want to point out a couple of things. First of all, up here at the very top is an APA guide. I'm opening it so we can see it. All right, so this APA guide is a quick down and dirty reference. And I'll tell you, when I started my doctorate, I went out and I bought the entire style guide, and then I realized I never use it. I only use, a few things. Well, as I got to the end of my dissertation, I did. But for the most part, you only use a few things. So if you look in here, it's going to tell you the format to use. Here it tells you like in-text citations, how to do those. It gives you examples. It tells you like what to do if there's no author. So there's a lot of, so referencing is right there. These are examples of like different types of publications that you're going to use. You're going to use a lot of this online publication. Most of them now have a DOI number. I don't know if any of you are old enough to remember the card catalog at the library, but the DOI number works like that.
I remember that.
I remember.
You remember that?
Yes, I do.
It's kind of like that number that's assigned to the book, except for it's electronic, right? You won't always have a DOI number. Sometimes you'll be citing a journal article that doesn't have one, and then you just leave it off. One of the interesting things with a DOI number is that you don't put a period at the end. If you're not using a DOI number, you always put a period at the end of your citation, but if you're using a DOI number, you don't. Oh, it looks like we don't if we use a website either. Okay, so these are good examples of how to do it. Now, the other thing that you need to know is you need to look up how to set up the cover page and how to set up the headers. But I will post an example for the headers on your paper because they're really a pain to set up. Okay, so this is the first thing. So you should know where this APA style guide is, and it's at the very beginning of where we have our research paper. Okay, so then you go down, and here's where the library is. So I'm going to click on the library. And the really nice thing about accounting classes is it takes you directly, well, I know it's, okay.
It makes you click the link.
Oh, I know. Say what?
It makes you click the link instead of to an external.
Oh, got it. Okay. All right. Let me go back there. Oh, wow. This is linked wrong. That's why. I have to tell, shoot. I'm going to have them relink this. So you can, okay. So Sharon Leitner, Dr. Leitner did a video. And I wonder if she put it in here. And I will show you how the library works without it. Basically, the video is going to tell you what I'm going to tell you. Dr. Leitner. Yep, it's not linking to, it should link to the accounting stuff. Let's see if this works. So I'm going to go straight to accounting. I bet it'll be here. Okay, so I clicked the link. Did you see where I went? On the
I didn't see it. Which one?
Okay, I'm going to go back and do it again. So on this page, I clicked here where it says selecting accounting resources under the library research guides.
Mm-hmm.
I clicked on this. And this takes you directly to the accounting section. Well, that takes you directly to the accounting section. And when you get here, you can go to this video. So here's home and here's the video. And if you go to this video, it's amazing. I did one like it and then she had this and I'm just like, okay, I'm done. So this is Dr. Leitner. And then this is the librarian on the right.
I have asked one of our key librarians to join me in a conversation.
So what this is going to do is this goes through how to start researching, how to use the online library. The other things here is we'll go to article search because you won't use book search so much or reference search. Bloomberg is for tax, but you can find company information in the 10Ks here. It's a subscription that we subscribe to. Wall Street Journal, you can go out on the web, but really what you want, and here's into more APA resources, what you really want is you want to go to article search. Okay, and then here's the business databases. And they say that it's slower if you select all of them, but I often select all of them anyway. But I'm going to go here. I'm going to go Business Source Primer, EBSCO, common one for business. What is somebody's wonder what my password is. Please work, please work, please work. Yay! Okay. What's somebody's topic?
You want mine?
Yeah, what's yours?
Mine is on Security Exchange Commission.
Okay. So I'm going to go down here and I'm going to say full text because I don't want abstracts. I only want the full article. And I'm going to click, this is already clicked down here where it says scholarly peer-reviewed journals. And down here for publication type, you have all of these different publications. I'm just going to say academic journal or trade publication. I just held down the control and clicked two things. And that's all I need. I'm not worried about the number of pages. For document type, I'm going to go ahead and put, not all, I'm going to go ahead and put article. I'm not worried about the month published. Okay, so now it's like SEC, yours is actually like comparing SEC's responsibilities in FASB, right?
Yeah, it's about the functions, role and functions.
So I'm just starting somewhere, right? I'm putting in a search that seems logical, and I'll say search. Okay, now here's where it gets really cool. So let's say, well, my initial search didn't yield any results. Okay, but this works. Filled it in for me. Okay, so now see over here where it says publication date on the left-hand side.
Mm-hmm.
And it says 1965 to 2018. So
Yes.
I want to limit it to like the last 5 years. So I put in 2012 there. And then I'm going to have it update. I just hit enter. Okay, so now I still have 241,000. That's kind of right, long. Okay, so I have clear article, all right, references available, academic journals. Okay, so I'm going to go here. I'm going to say, somehow it got all results there.
Mm-hmm.
I'm going to unclick all results and just click academic journals. Oh, see, I'm down to 239,000. Okay, but see, my subject has gone. So we'll try SEC. Well, there we go. So now when you look at these articles, what you're going to look at is down here it says PDF full text. So you're going to read the abstract. So the first thing I do when I'm doing it is I like look at the title and I'm like, okay, that's not going to work. Oh, this one might. So the first thing I'm going to do is I'm going to read the, I'm looking for one that's interesting to me. Okay, so here, so I'm going to click on this and I'm going to say, all right, let me look at what the abstract says. So I'm going to read the abstract. Sometimes they're much longer than this. And from the abstract, I'll decide, oh, okay, I think I want to use this article, right? Mm-hmm. So there's a couple of things that you can do from here. One is, and this is what I normally do. So over here on the right-hand side where it says cite, it will actually give me the citation. So here I'm going to say cite, and then I'm going to scroll down here to APA, and what I typically do is print this so that I have the APA citation already. I don't have to figure out how to do it. Are we good so far?
So you're going to copy that one?
Yeah, I either copy it onto a sheet of paper or I just print the page.
Oh, okay.
So that I have the APA reference because it gives it to me exactly how to use it. You know, or if you're writing your paper, I mean, you can stick it right in. But typically you don't know what articles you're going to use. If you're sure you're going to use it, you could just put it straight into your article. When I want to see the full article, I'm going to click over here on PDF full text. And it'll give me the entire article, right? So now I can read it. You can download it if you want to. So then the next thing I can do is, I have two choices for saving it. Let's say I'm trolling and I want to figure out, you know, I'm not sure which ones I'm going to use yet. I'm looking. You can put it in this folder that's over here on the right-hand side where it says add to folder. But if you use that folder, it shuts out at the end of whatever time you're searching. But if you want to keep things in your folder, then what you do is you go up here to the top bar and you say sign in. And what this does is this creates a folder that it'll even hold the stuff the entire time you're in school, and you can put it by category. So it's an EBSCO folder. It's working. It may have my stuff for my doctorate in it. Let's see.
Are we gonna have an EBSCO
Yep.
login also?
Okay, I'm not sure what happened here. Let me go back. Really? Oh, by the way, here's the librarian chat. You know that you can ask the librarian, I'm looking at while I talk. You can ask the librarian questions and ask them to help you find stuff. Oh, just reading, I need to read what somebody just wrote. Deloitte has a really awesome write-up on this as applied to private companies. Okay, we'll go look at that. You set up an EBSCO login and password. So here's my folder. Okay, and so I have no articles in it right now. I can set up all of these different, like I can change the title, like when I was writing my dissertation. I'm gonna say sign into EBSCO host. Now what happened last time? It took me somewhere weird. Oh, so if you didn't have an account, you can say create one now. And here I'm gonna, I'll say I already have one. I'll use, actually, I don't think there's a period. Six character, one special character, okay. Okay, so I've set up a folder. Wait, did it already take it? I think it did, I think it did, I think it did. Now, the nice thing about this folder is this, why does it keep going away? Maybe I have to add something to it first. Let's try that. So I'm gonna go to my article search, and let's say we wanna say, what's the problem? SEC and FASB. (2012). Now you see there's 74 academic sources. Okay, so correction to the accounting standards, the primacy of fair value. Okay, so here, I'm clicking on this, and I can see the whole article here. I want to click here so that I can get the citation. But also now I can say folder. Okay, I don't know why it's not going in my folder. I am signed in because that's my folder. Oh, I remember why. It's been a while since I did this. Oh, and by the way, instead of doing what I'm doing, say go back to results. Because I'm doing this the hard way. So over here, see this folder? I'm going to say, I'm going to put it in my folder. So I'm like, okay, I want that, and I want that, and I want that. There they are. Now they're in my EBSCO folder. And so I can categorize these. I can say like, I forgot how to change the name. You can change the name though. You can change the names here because I set mine up for like different topics. All right, so these are in your folder. The nice thing about these being in your folder is that you can go away and come back the next day and start researching and they'll still be there. So you don't have to print them. Okay, so some of them don't have the full text. They link to another place. I just don't even use them. But you can check it and go to a different link to get the full text for those. So you just do this, it just goes to an external database. Okay, this one isn't gonna let us. And that's why I don't like them, because some of them you can't get to. All right, so full text article in your folder with an abstract. Oh, this is a good one. How many pages is this? Oh, only 7 pages. This is a good article for you. All right, so you can still go over here and cite it. You can also export it. You can email it to you. You can print it. You can email it to yourself. But I really recommend just putting them in your folder, but not this folder. This folder on this side only keeps it for a little while until you exit. The folder here at the top keeps it indefinitely. You can keep it throughout your entire program. Okay, what other questions are there about the library? Okay, you guys, you're being really quiet again.
I'm good. I got it.
So I just Googled Deloitte and revenue recognition. This is one of those exceptions. Deloitte does a lot of really good resources. So this is one of those exceptions to going out on the web. So, and she's right. So like implementing the new revenue recognition standards are here. Here's the roadmap. Actually like the roadmap. Here's an overview. This is really, and here's the roadmap, which is really helpful. It's also 838 pages, so clearly you don't want to read all of it. But see, we're not dealing with consolidations, contracts, discontinued operations. I mean, common control transactions. So you can download the roadmap. Yeah, there's a lot of good information on Deloitte's website. There always is. By the way, this is another place to go for SEC and GAAP. It's just as good as using an academic journal. Okay. Anything else here? Is there anyone who feels like they could not use the library?
Nope, I'm good.
Okay, it's really important to be able to use the library. Okay, all right. Go back to Blackboard.
I had a question on the formatting because you did mention to double space, not single.
Yeah, I'm not going to take off if you single space, but it's not APA.
But it also says not to include a title page or abstract. So
Yeah, you don't need an abstract. I would use a title page because it's APA, but I'm not going to take off if you don't. But it's too short a paper to use an abstract.
Okay, just making sure.
Yeah, I know that you're beginning this journey. So, and I don't know, and some of you, it's been longer since you were in undergrad. Right, it does say, so if you double space, it's not 2 to 3 pages, it's 4 to 6. Right? If you double space, you double the number of pages. I don't take off for formatting, I explain what you should have done so that you know it for the next class. So you don't have to worry that, you know, if you miss a dot or a tittle in the reference. I used to say I wouldn't know if you did, but since I wrote my dissertation, I would know if you did. But I'm looking for, I will take off if you write the paper and you don't show any references, but a big part of that is taking off because you didn't meet the requirements of the assignment.
Have any minimum or maximum?
Let's see, is there anything else? Paper should start with the statement of the issue you will be discussing. Okay, any other questions about the paper? Or are you good? Okay. All right, then we're going to go and we're going to look at revenue recognition. Okay, so this is one of those times where it's really, really helpful for you to go back and think about what you already know about revenue, because a lot of what you already know about revenue hasn't changed. So what do we already know about when to recognize revenue? When do we recognize revenue?
When goods or services.
Expenses.
When we sell it?
In the correct period.
Right, when we earn, we recognize revenue when we earn it, and we recognize expenses when they're incurred, right? So when we're talking about revenue recognition, nothing has changed about recognizing revenue when it's earned. What has changed is some of the more complex transactions, and as far as like, when do we recognize the revenue on those? When do we consider it earned? But it doesn't say, there's nothing about this that goes outside the parameters of recognizing revenue when it's earned. So you already understand a huge, big part of the basics, right? And that's why I said it's important to remember, like, think about what you already know. Okay, so I wanted to go through some of the rules. All right, you already know what revenues are. And you already know why they're important, so I'm going to skip over that. So prior to this, GAAP only recognized revenue when the earnings process, and there are exceptions, which I'll talk about, when the earnings process is complete. So what makes the earnings process complete?
That means if the buyer receive the product and then
Yep.
satisfied with, and then he pay.
If the buyer receives the product. So when the buyer receives the product, then we have completed the earning cycle. Let's see if I can. Wait, that's what I meant to do. What I meant to do was give myself more room on the screen. Okay, and also get it where I can see the whole chat pod, which I don't seem to be able to see. There we go. Oh, I have my bar. I'm struggling with technology tonight.
I've been struggling with technology all day today. It can go take a hike.
I looked at my husband's computer right before and I noticed that it was like doing an update. And I'm like, oh, no. What the heck? Why can I not move this? Okay, I'll have to figure out why I can't move it in a minute. I'm not seeing all the chats. I'm only getting down to, is there a minimum or maximum? Which is really weird. Oh, there we go. Now I got to move it. Yay. Now I'm, whoopsie. See, technology, it's driving me crazy today. Okay. There we go. I'm happy now. All right, so earnings process completely correct. And you're right. contract obligations are filled, and that's one of the issues that we're going to have, like with longer jobs. One of the issues with revenue recognition, it's pretty plain when it's just a simple buy it and you're done. But when you have like a process where you're, say, building a building, right? So if you're building a building and you need to, it's going to take you, 6 or 9 months to build it, you want to recognize some of the revenue as you go along. And so that's one of the things that the revenue recognition addresses. So it can get more complicated than just the transactions that we're used to thinking of. And then you're right, when it's collected, it doesn't have to be collected, because think if we sold something to a customer and we delivered it, but we invoiced them and they're going to pay us in 30 days. Have we still earned the money? Yeah, we've still earned the money, whether they've paid us now or not, because we fulfilled the requirements for the job, right? So, but there is this second caveat, which is it has to be reasonable certainty that you're going to collect the payment from the job. And that goes into, like, when we sell things, obviously with what we've looked at so far, we've used the allowance method for accounts receivable, right? This is talking more about, let's say we sell a larger job and they're going to pay us out over time. We don't want to recognize all of the revenue all at once in the old way, because if we're not sure that we're going to get paid, we don't want to recognize the revenue. Okay, so that's GAAP. And I just talked about some of the problems. With the new revenue recognition standard, we've brought ourselves, you've heard Convergence, right? So with Convergence, we're trying to take GAAP and see how we can adjust it to be closer to international reporting standards. And the revenue recognition policy is literally almost there. So the new revenue recognition principle says that you can recognize revenue when you transfer the goods to the customer. Has that changed? Is that any different? No, it's not any different. Right. Thanks for chatting. It's not any different at all. The difference is how much revenue we can recognize. So we can recognize the amount that we're entitled to receive. So that's different than GAAP, because with GAAP, it wasn't the amount that we were entitled to receive, it was the amount that we thought we would receive. Are we good with the difference? And it might be a good idea here to like write down in your notebook, like have a column for old GAAP and a column for, new principles. All right, so these are the steps that you want to follow, and these are the steps that we're going to use when we do the chat and the homework. So the first thing that you want to do is you want to identify the contract. So you want to, if you were like auditing or something, or if you were in your office and doing accounting work, you would read the contract and you're going to see, okay, what are my jobs, and what am I supposed to deliver? When am I supposed to deliver it? What is the relationship with the customer? Now, is that anything new? That's nothing new. We already do that. Then the next thing you're going to figure out is there one performance that I'm going to do? Like I made the cushions, I delivered them to the Hilton, they pay me. Or are there multiple? Like I have this building and I'm going to, build it, and then I'm going to do the addition, and then I'm going to, do the landscaping outside. There's multiple performance obligations. Then you have to figure out the price, because remember, we're going to record based on what we are planning to charge for the service, which again is not different. That's what we've always done. Then we're going to take the part that's different is we're going to allocate the transaction price. So if it's single, then there's no allocation. It's just what we've always done. We do the service and we collect the money later. If there's multiple pieces of the sales transaction, then we're going to take each piece and look at, what is the performance obligation on each piece. And we're going to use that performance obligation over time to figure out when to recognize revenue. Now, we've done this before. We did this for, this is one of the ways that we could recognize contracts. like when we have an extended contract that we're working. You could do it by percentage of completion, looking at how much we finished and then figuring out the revenue, or you could do it based on, you know, benchmarks in the whole job. All right, are we good here? Yes. All right, we already know what the single point in time is, so we're just going to go completely over this because we already know this part. There's nothing new here. And see, there's nothing new with the journal entries either. Accounts receivable, sales revenue. So although this chapter looks daunting, when you take it and you say, well, it's really not, because part of this I already know. This is no different than what we've been doing. It's no different than what you did in 601. So all of the single point, you're good with. Now, what we haven't looked at is revenue over a period of time. That's the new piece. So we're going to recognize revenue over a period of time if the customer consumes the benefit over a period of time. The customer has to control the asset after it's been created. So like if you made a building extension, you can't be leasing it. It has to belong to the customer. This is not new either. That in order to recognize revenue, you still have to have provided a service or a product. That's all that 1 and 2 are saying. That's it. So there's still nothing new here. All right, so let's look at an example. So TrueTech Industries sells 1-year subscriptions to the TriNet multi-user platform of internet-based games. TrueTech sells 1,000 subscriptions for $60 each on January 1st, 2016. Okay, we already know this one. Oh no, we're going to use deferred revenue. All right, so we used to use unearned revenue for this. But in this case, what we have, unearned revenue is the same as deferred revenue. It's just a different name. So when you look at this, don't be confused, because what does deferred mean?
We're going to push right in.
Recognition. Exactly. Deferred means we push off the recognition. Depending on what textbook you used when you were looking at adjusting entries, sometimes they're called deferred revenue and deferred expenses as categories. Some books just use prepaid expenses and unearned revenue. But what unearned revenue is a deferred revenue. We've gotten the cash now, but we've deferred, we've put off recognizing the revenue. So although this looks like it's new because it has a different term, deferred revenue is synonymous with unearned revenue. Are we good there?
Mm-hmm.
So that'll help. It's like it's not as different as it looks. And we already know about this too. So here we're just reducing deferred revenue instead of reducing unearned revenue. But other than that, it's exactly the same as what you did when you did adjusting entries so far. So let's say that we're going to work a project over time and we want to recognize revenue as we go along, because we want to recognize revenue as we go along because we have expenses that we have to recognize as we go along. Right? So we want to match the revenue with the expenses. So you want to put in some revenue as you go along on a project. So there's a couple of different ways to figure out how much have we finished, because if you're going to recognize revenue as you go along, then you have to be able to figure out where are you in the process. I mean, are we 25%? Are we 50%? How much revenue do we recognize? There's different ways of doing that estimate, because that's all it is, it's an estimate. One is output-based. So output-based simply means that we're going to figure out, like with my cushions, let's say that I was delivering, you know, the job in 4 batches, huge job, you know, 4 batches of 250 cushions each. So then every time I deliver a batch of cushions, I would recognize the revenue for that particular batch of cushions. So it's output-based. You know, what have you completed in this period of time? The other way you can do it is based on input. So with input, what we're doing is we're figuring out, well, of the whole job, how much have we invested so far? So it says measured as the proportion of effort expended. Well, we're not talking about measuring effort, like, you know, how hard did you work at it? What we're really looking at there is what are our costs so far based on what we think our cost for the whole project will be. So we're trying to figure out, you know, what percentage have we finished? Both of these are a way of figuring out what percentage have we finished. Which of the following is not an indicator that control of a good has passed from the seller to the buyer? Go ahead and type it in the chat pod. You know, I should do a poll. A poll would be fun. Oh, I haven't done them in Zoom. Oh, I have to type the question. Okay, we'll go back to figuring that out. So which of the following is, am I sharing concept check? Someone speak up. Am I sharing the slide with ABCD on it?
Yes, ma'am.
You are.
Okay.
Yes.
So which of the following is not an indicator that control of a good has passed from the seller to the buyer? So in other words, which of the following is not an indication that the sale is complete? Okay.
The buyer schedule a delivery.
Right. Why is C the one that means revenue? What does it take for revenue to be recognized? The buyer can't just schedule the delivery. What has to happen?
Delivery.
It has to be delivered. Exactly. Because it has to transfer hands. But the other thing about this concept check is if you wanted to switch it, you could say, which of the following, you know, which of the following is an indicator? And so the buyer has legal title. The buyer has an unconditional obligation to pay, and the buyer has assumed the risks of ownership, which is basically you've transferred the product or the service. Good job, you guys. Which of the following is an indicator that revenue for a service should be recognized over time instead of at one point in time? This is a little more tricky.
I guess I'll go with the A.
Well, okay, so first of all, one of the techniques for taking multiple choice tests is that the longest answer is usually the correct one. Don't think that's the case here, though. Oh, yeah, it is. The seller is in here. So
I just guess.
no, but when you're going to guess, let's say you're going to guess on multiple choice, it usually is the longest one is the right answer. Not always. Not
Okay.
always. But if you're looking at a question on a test and you're like, oh, I don't know, then I would pick the longest one. So the seller is enhancing an asset that the buyer controls as the service is performed. In other words, they're relinquishing pieces of it. So because it says the buyer controls it, so we're relinquishing pieces of the job. Does that make sense?
Yes.
So it doesn't matter if we're providing continuous effort because, for instance, let's say that I'm selling 250 cushions to the Hilton. Am I going to recognize revenue because my seamstresses are sewing?
No, you recognize it when it's done.
Right. So my effort doesn't matter. It's the end product that matters. Kind of like I tell people all the time, you know, it's like the only person that cares about how much effort you put into it is your mom. Everybody else cares about the outcome of your effort. The seller can estimate the percent of work complete. They have to be able to do that to recognize it over time, but that's not an indication that they should recognize it over time. All right. So here we have, let's say that we have a contract and we think that we're going to have these multiple performance obligations. So there's like steps in the contract, right? First we identify the contract. Then we figure out where are the points in the contract that we're going to, you know, transfer service or product and should receive, you know, recognize revenue. And then that's what we're going to do. Once we figure out like what's our total revenue, then it's as easy as what percentage did we finish? Okay, we'll recognize that percentage. Or what did we already transfer to the customer and what percentage is that of the total? Okay, we'll recognize that percentage. All right. This is not, we've done this. This is, and they're all here for you. I'm not taking them away, but we've done this. Okay, so let's say that it has multiple performance obligations. So the first thing we do is we make sure that we understand the contract. Then we can say try-box module or try-net. Okay. I don't know. Oh, it's just this. Okay, we've done this. These are not new. Shoot. All right, let's look at it anyway. Allen Company wrote a contract that involves two performance obligations. Product A has a standalone selling price of $100. So when we finish product A, we're gonna recognize the revenue. And product B has a standalone selling price of $200. The price for the combined product is $240. How much of the transaction price would be allocated to the performance obligation for delivering product A? So what we're doing here is we're saying, so separately, they'd be worth $300, but that's not what we sold them for. We're selling them for $240, right? Yes?
Yes, ma'am.
So we're going to say for product A, now what we need to do is we know the price of what we're really doing here. Let me make this less confusing. What we're really doing here I can't get to any of my tools. There we go. I'll take it. There we go. So what we're really doing here is we're saying, and we use this technique a lot. So we're saying the total is we have 100 and the other one is $200, right? So we have a total of $300. So 100 is 1/3 of the total price, and $200 is 2/3 of the total price. So if I combine them, and now my total selling price is $240, for A, I'm going to say 240 times 0.33, and what does that equal? It should equal, better equal 80.
You multiply them together, 79.2.
240 times 0.33. Yeah, 79.2. So basically about $80. And then for the other one, if you said 240, I mean, you can just subtract, but times 0.66, that's what we're really doing with this formula.
158.4.
Yeah, so we're rounding, so 160. Maybe I did 1/3, 1 divided by 3. No, 0.33. So what we're doing here is basically the same thing. We're saying the $100 divided by 300 gives you your percentage. This is the 0.33. Times the 240 gives you the 80. That's what we're really doing. But the formula down here doesn't make it clear. And this we've used when we've bought lump purchases for like fixed assets, right? Uh-huh. What are you thinking?
No, I was thinking about it's right. The formula is right.
Yeah, I just wanted to explain it because because this technique is something that we use frequently in accounting. So we use it for lump sum purchases. We use it when we're trying to allocate a cost or revenue over different sales, right? So the way we're doing this is important to understand because we use it a lot. All right, so that's how we figured out that A should be 80. We know it's not 100 because we're selling it combined for 240 instead of 300. Good here? Yes, no, maybe? You're not speaking to me? Are you guys mad at me? Nobody's talking to me?
Still here, totally get it.
We're processing, so we're processing.
Okay, processing is good.
Oh.
Have you processed enough for me to go on?
Yes, ma'am.
How do I get the information for the paper in class? in syllabus on week 3 tab in course. Okay. All right, next one. So this is just, if you were gonna like print something out that you could use on the test, this is what you could print out. Join class. All right. And these are the steps that we already talked about. So with special issues, these are the things we're gonna think about. The specific requirements to make sure there's a contract, but that's the same as your step 1 before. Some of the special issues that we have is like prepayment if they pay ahead of time, or warranties, because with a warranty, there's 2 different kinds of warranties. There's the add-on, like when you're standing at the cash register and they say, would you like to purchase this additional warranty? That's a separate sale all by itself. But the warranty that I'm talking about here is like the manufacturer warranty. So you buy the new washing machine and there's a warranty for several years that comes with it. On your side, you're looking at that as good, I'm protected from, you know, costly repairs. On the company side, they have to record some kind of, you know, expense related to what they think the warranties are going to be. Good. So you want to explain, you want to figure out how much you think you're going to spend on warranties over the next 3 or 4 years, however long the warranty period is, and recognize those costs in the year of the sale. So why would you want to estimate warranties and recognize them in the year of the sale?
That's when the sale happened.
That's when the sale happened, exactly. So you recognize the revenue at that point in time. So you want to recognize any expenses that you anticipate for warranties when you recognize the revenue. Some of the other issues that we have to look at is like time value of money. And there's some sales where you're paying them out over time. And so down the road, you're adjusting that amount for the time value of money. Right of return, remember one of the requirements is that the customer is going to keep it and take ownership of it. You could look at, you know, the payments that they're making to the seller as a way of recognizing revenue. Okay. So if you've taken business law, then you know what makes a contract, right? So that's easy to go through. It has to have commercial substance. It has to be approved. You know, everybody has their own rights, the right to take ownership and the right to produce and sell. It's going to specify payment terms, and you're looking for a probability that the seller will be able to collect the money. All right, and you can see the performance obligations. So as a promotion, True Tech Industries offers a 50% coupon. These are fun. 50% coupon, and this is a great time to do this because everyone's shopping for sales at Christmas time, and so you can kind of see what happens with that. So offers a 50% coupon for a gaming headset with the purchase of a TriBox at its normal price of $240. So the headset normally costs $120, but we're selling it for $60, as long as they've bought the TriBox, which is probably a gaming something or other. The customer has 1 year to redeem that coupon for 50% off the headset. So after 1 year, they no longer have that option. It goes away. True Tech estimates that 80% of the customers are going to take advantage of the coupon. So now we have to figure out with that coupon, how are we going to record how much the coupon is worth? So we sold 100 TriBoxes under this promotion on January 1st, 2016. So what we're going to do is we're going to look at, okay, 50% discount is $60. So $60 times 80% of our customers is really going to be like $48 per sale. Now, every customer that redeems it, it'll be worth $60. But the way we adjust for the 80% is we say, okay, so $60, but only 80% of the people will claim it, so that ends up being $48 per sale. Because we don't know who's going to claim it and who isn't. Good so far?
Yes, ma'am.
Okay, someone's talking. All right, so now here's what we have. So the standalone selling price is $240 plus the $48 for the coupon. So what we're really doing is selling a product that is worth $288. Now, that's not what they're paying us. They're paying us $240. We're giving them the coupon, right? So, but we need to allocate revenue. So they paid us $240 times 100 units. So we collected $24,000 in cash. But we want to look at what's the sales revenue and what's the deferred revenue. So the deferred revenue is the part that would be attributed to selling the headsets for $60, which is what we're basically doing by giving them the coupon. So what we're doing with TriBox is we're saying the total is $288. We're doing the same technique that I just showed you. TriBox is 240 out of the 288. So that's 83.33% of the selling price. So it's 83.33% of the $24,000. And the coupon is $48. So that's 16.67% or 1/6. So if I take my 240,000 times 100, I get $20,000. Or I could say the total's 240,000, 24,000, sorry, times 0.8333. And that comes out at 20,000 also. Does that make sense? The other thing that I could do here is I'm saying, okay, so TriBox, so TriBox is 83.33%. So I could also say 24,000, my total selling price, right? The total cash I'm collecting, times 83.33% equals 20,000. And if I took my 24,000 times 16.67, that equals 4,000. So that's the other way you can do it. For me, this way is clearer. You can choose either way of looking at it, but does this make sense?
Yes.
Okay, Catherine's talking, which is amazing because she finally has a voice and she's been talking even when she doesn't. How's everybody else doing? Okay, I'm seeing yeses in the chat pod.
Yes.
Okay. So how would TrueTech account for this arrangement if it normally sells a headset at a 15% discount off of its $120 list price? So that means that the normal price of the headset isn't $120. So they're not really getting a 50% discount because we normally sell it at 15% off. So we're going to take that 50% discount and we're going to subtract the 15% because this is really the discount that we're offering them. Because if we normally sell it at a 15% discount, that means that the $120 times 0.85, it means that we don't actually sell it for 120 very often. We sell it for 102 with this 15% discount. Are we good there?
Yes.
So we only have, so we're talking about a 50% discount. We normally take 15% off. So the real change is actually 35%. So if I take my total price of 120 times 35%, then I get my 42. Now, the other way of doing that is I could say my selling price is actually $102 because I always give them 15% off. Actually, that doesn't work. 102 times 0.15, 15 that doesn't work. Oh, because I'm doing it the wrong way. 102 times 85. 90, nope, okay. So now what we know is, we know that with the 35% discount, each one of the coupons is actually worth $42. So we're giving the customer something worth $42. So we're going to say, here's our $42 per customer, and here's our estimate of what percentage will be collected, how many will turn in the coupons. So now each coupon is worth $33.60 to us. So that's what happens if we don't normally sell it for 102. And now we're going to work it exactly the same way, except for this time we're taking 24,000 times 87.72 to get the 21,053. And down here and so we're saying the 33.6 divided by the total price, 273.60. So that's how we figure out that the coupon is 12.28% of the sale. All right, so the reason that we have to do this is because of revenue recognition. So immediately we're going to receive the cash, right? I mean, obviously we're going to receive the cash right away. But then we have part sales revenue. So this is revenue because we sold them the product, right? This is deferred revenue. And the reason it's deferred revenue is because we're not going to recognize that revenue until the customers turn in their coupons. When they do that, we'll take it out of deferred revenue and recognize sales revenue at a discounted price. Are we good here?
Yes.
No one's talking. We're going to do this. Oh shoot, I forgot to turn. Okay, so let's practice it. How about everybody calculates it on their own, and let's see if we come up with the right answer. So Hooper Inc. offers a discount on an extended warranty on its iPhone when the warranty is purchased at the time the iPhone is purchased. The warranty normally has a price of $300, but Hooper offers it for $240 if it's purchased along with the iPhone. I found that so funny. Hooper anticipates a 75% chance that a customer will purchase the extended warranty along with the iPhone. So when you're selling a separate warranty, that's why you're recognizing separate revenue. So let's assume that Hooper sells 1,000 iPhones that have the extended warranty. What is the total standalone selling price that Hooper would use for the extended warranty discount options for purposes of allocating the revenue? Let's see if you guys can work it. When you've got it, tell me. How you doing? Are you guys doing anything? Are you working it or are you lost?
Working it.
Okay.
I think I'm lost.
Okay. So let's look at why. All right, so normally it sells for $300, but the company's selling it for $240. So that is a $60 discount, right? So we're going to take the $60 discount, has a 75% chance of being taken by a customer. So the standalone selling price associated with 1,000 iPhones is $45,000. And the way we did that is we said, okay, we're going to take the discount of $60 times 0.75. Get my calculator to work. 0.75% of them. is $45, and we're selling 1,000 phones. So that's how we got the $45,000 just for the contracts. So all we're doing here is we're saying, we're looking at these. All we have is the warranty normally sells for $300. Instead, it's selling for $240 when you purchase it with the iPhone. And they think that 75% of their customers are going to purchase it. Good, Sherilyn. We think that 75% of our customers are going to purchase it. So we're giving them a 60% discount that 75% of them will take. I mean, we're selling them a $60 product that 75% of them will take. And that's where we're getting the $45,000 for. This $45,000 has nothing to do with the phone. This $45,000 has to do with selling the warranties. Does that make sense?
Yes.
So we're making progress. At least one person is. So sometimes you're not given the selling price and you have to figure out what the selling price is, or sometimes you're given a lump sum and you have to figure out what the selling price is. We should take a break. It's 10:09. Okay, this you can read. Okay, we'll look at this. All right, let's take a 10-minute break and we'll come back. This is too much to think about without stopping. Are you good? Come back at 20 after? Say yes. I'm going to turn my mic off, but I'm going to keep recording because otherwise I'll forget to turn it back on.
Bless you.
Answer the question.
then I'll be caught up with week 3 with everybody else.
Okay, you're doing great. All right, so let's see. Now we got to keep going. All right, this is the same. This is exactly the same concept. Can you guys hear me? You can, right? Yes, okay. Gotta move my chat copy in. Oops. Oh, sorry. Sorry, I forgot to hang up the phone. God. I don't blame you, Catherine.
Born to party, right, Professor? Till about 9
Yeah.
o'clock.
Yeah. No kidding. Yeah, that's my whole plan. Yep. Same concept here. Why can I not go anywhere? God, I'm tired of technology. Oh, it is going. Okay. Same concept. So let's work a few problems and see where we are with it. So let's go back to the course. Am I sharing the course?
Yeah, I see your course outline.
Oh, I'm not showing the course then. Week 3. Oops, wrong one. Gosh, I think I think I just need to dye my hair blonde.
I want to see that.
That's what I need to. I just need to dye it blonde. Now I have to go find a blonde wig. I'm impressed. 7 students in progress. So is this redundant or am I clarifying things for you?
Clarifying.
Okay. It's a real question because some of you are going to be with me in the next class too. So I really want to do what's most helpful to you, obviously, because I already know the material, right? I don't have to learn it. All right, so this is exactly like what we were doing. So requirement 1, when should Ski West recognize revenue from the sale of its season passes? All right, so Ski West Inc. operates a downhill ski area, I remember this question, near Lake Tahoe. An all-day adult lift ticket can be purchased for $85. Adult customers can purchase a season pass that entitles the pass holder to ski any day during the season.
Equally through the season.
Equally through the season. That's so weird. I know this question. Which typically runs from December 1st through April 30th. So 12/1 through April 30th. How many months is that?
4.
Okay, this is an excellent example because this is the biggest problem with questions like this and depreciation. And so it's really important to double check. And I had the same problem. There's a test that I used to give and every couple of years I'd rework it. And the depreciation question I always got off on. So like the way I look at it, I say, okay, so we've got December, right? From December 1st.
It's 5 months.
It's 5 months to April 30th. So December, January, February, March, April. Because we're so used to things being given at like the first of the month. So we actually have 5 months. Common mistake. All right, so we expect the season pass holders to use their passes equally throughout the season. Why is that important to me?
So you can accrue it correctly over periods.
Right, so that I know when I anticipate earning the revenue. So on November 6, 2018, Jake Lawson purchased a season pass for $450. When do I recognize the revenue from the sale of the season passes?
And they use it?
When you get the money.
Okay, so let's think about that. If I buy a season pass,
But
and
it's accrued over a period of time.
right, so I'm not going to recognize all the revenue when I get the money.
No.
So I am going to recognize it over time, but how am I going to do that? The trick here is that they say that we anticipate them using the passes equally throughout the season. So we're going to recognize the revenue equally throughout the season. Does that make sense? This one's kind of a review. Well, and see, we would do it each time they use the pass, except for I'm struggling with number 5 on the homework, or the Catherine, on the homework or on the chat problems. Okay, good. So equally throughout the season. If it was like the magazines, we're going to recognize the revenue on the magazines that are sent out each month. But the key here is that we anticipate them using them equally throughout the season, so we can go ahead and just record the revenue equally throughout the season. So then requirement 2. We want the journal entry that they're going to record on November 6th and December 31st. So what has happened on November 6th?
Cash.
They got the cash for exactly, they got the cash. So what are we going to recognize? When they get the cash, we have to record an entry, right?
Deferred revenue.
Yes, so we know we're going to record cash for
$450.
Yeah, $450. And we have deferred revenue, which this is not new. I'll go to 5 and try it too. $450. So that's recognizing the sale of the season pass. Now the second thing we're going to do is now we're going to record recognition of the revenue in December. So if the season pass was for $450, valid for how many months?
5.
So how much revenue are we earning per month?
90.
So 90 times 5 is 450, right? So now we're going to reduce the deferred revenue, and this is a good time to use T accounts. And we're going to recognize
Sales revenue.
Sales revenue. $490. So requirement 3. So now we want to know what would be included in Ski West 2018 income statement and balance sheet related to the season pass to Jake Lawson. What date? Oh, in the 2018 income statement. All right, so how much revenue did we recognize?
90.
We recognized $90 worth of revenue that's going to be on the income statement. And then we recognize, so what's left? We started out with
360 and deferred.
Okay, so we have 360, and where do we see deferred revenue? So
my brain's not working.
that's okay. What type of account is deferred revenue?
Liability.
Yes. So what financial statement do you see liabilities on? Assets, liabilities, and equity.
Balance sheet.
Yay, balance sheet. Your mind's engaged again. See, it's working.
No, it's still broken.
It's okay.
Out the last of the rag.
I'm going to go to 5 just for the fun of it. Oh, heavens. Oh, this is just like what we've been doing. Okay, Rocky Guides Service provides guided 1 to 5. I'm like, is that 15 or 1 to 5? My contacts don't like to work this late. 1 to 5 day hiking tours. throughout the Rocky Mountains. Wilderness Tours hires Rocky to lead various tours that Wilderness sells. Rocky receives $1,000 per tour day.
Shortly after the end of day each month, Rocky learns whether he'll receive a $100 bonus per tour day.
It guided during the previous month. If its service during the month received an average evaluation of excellent by Wilderness customers, the $1,000, so he receives the bonus if he got excellent. But when does he know about that? He doesn't know until the following month, right? But when is the expense actually incurred?
I didn't realize I was moody.
Oh, sorry, I muted everyone because there was some noise going on. That noise.
He receives $1,000 per tour day. Shortly
Right.
after end of month, he'll receive a bonus from the previous month.
Right, of $100 per tour day.
If its evaluation is excellent.
Right, the average evaluation is excellent. So if he ends up having an average of an excellent evaluation, then he's actually getting $1,100 per day. Okay, and they pay the $1,000 per, wow, that's a lot of money, $1,000 per day, and then the bonus as a lump sum. Okay, so on July 1st, based on prior experience, Rocky estimates there's a 30% chance it will earn the bonus for July tours. And it guided a total of 10 days from July 1st through July 15th. So we want to record Rocky's July 15th journal entry to record revenue for tours given from July 1st to July 15th.
Accounts receivable, service revenue.
How do we know it's account receivable?
Because
they haven't received it yet, right? They received it the next month.
Yeah. And since it's 10 days times 1,000 is 10.
So we have 10 days times 1,000. We don't know about the bonus yet, but what does they say? 35%, 30% chance it will earn the bonus. Okay, so we have to get to that too, but I don't think we're doing that with this one, are we? So we have $1,000 times where does it say how many tours they did? Oh, on July 1st.
He had 10 days, so it's 1,000 times 10.
$1,000 per tour day. Okay, so $1,000 times 10. And service revenue. I know the answer is not complete. All right, so that's the first one. All we did there was recognize service revenue. That is nothing new. All right, the next thing we're going to do is we're going to record Rocky's July 31st journal entry to record revenue for tours given July 16th to July 31st. So that's not hard either. So how many days is that? 16 days?
15.
15?
Yeah, 15 days
Okay.
times 1,000 per day gives that 15,000, which would be accounts receivable.
Yeah, and service revenue. It's the same thing. It's just the last part of the month.
But there's going to be a bonus revenue of
Hold on, is this sales revenue or what do we say? Sales revenue or service revenue?
Bonus receivable is going to be 2,500 on the debit side, and then service revenue 17,500 on the credit.
how did you calculate the 2,500? He gets a $100 bonus, but there's only a 35% chance he's going to get it.
So $100 per day times 10 days plus 15 days equals 2,500.
So we have $100 times the total number of days that he worked that month, which is 25, right?
Yes.
2,500. Okay, what did you do with the 35%? Oh, we're still just recording revenue.
We're just recording revenue.
This is where I got stuck.
Okay, that's why we're talking about it.
Thank
Wait,
you.
at the end of the month for 10,000 because it's 10 days, 15, so 15,000. Okay, so how much do we agree on that accounts receivable is?
15,000.
For the 15 days, right?
Yes.
And then we have service revenue and what else?
Bonus receivable as 2,500 on the debit side.
Yep, that's good. How do I get it off? I didn't know how to, oh, I clicked the blank. I didn't know how to stop it. Because we're estimating how much the bonus is going to be.
Yes.
And then we have sales revenue. Are we calling it sales or service revenue?
Service revenue.
Okay, that makes more sense. So the bonus receivable is $100 times 25 days times 35%. Do you agree?
$100 a day times 25 days is 2,500 for the bonus receivable.
Right. But what are you doing with?
They don't factor in the percentages.
Yeah. Okay. Bonus receivable service revenue was 15,000, and
17. The total is 17,500.
oh, for service revenue.
Yeah. So credit will be
Okay.
7,500.
So we've done this because the accounts receivable is. Let me get back where you can see it. So the accounts receivable is what they're going to pay us. They're not necessarily, so they're going to pay us $15,000 for the service and then possibly $2,500 for the bonus. And so that's all service revenue. Are we good here? Even though he may not collect the bonus. So what's the third one? Record Rocky's August 5th journal entry to record the receipt of payment from the Wilderness. Okay, so now they're going to pay. So the question is, how much are they going to pay? It doesn't say if he, learned it did not receive an average evaluation of excellent. Oh, August 5th. Yeah, for its July tours.
So cash and accounts receivable.
Yeah, so the problem here is that we've recognized a bonus receivable that he's not going to get. So we'll write down what he is going to get. How much cash is he going to get? 25,000.
25,000.
That's a good thing to keep track of in a T account, by the way. And we're going to eliminate accounts receivable. How much do we put in accounts receivable?
25,000.
10, 25, because when we pay it, we know that it's all gone. So we're going to take this out of accounts receivable. Now, what am I going to do with the bonus?
It's on the next journal entry.
Because I have to do something with it because we recorded bonus revenue. So to record any necessary adjustments to revenue. So we're going to go back and we're looking at how did we record it? Well, it's this bonus receivable that we're not going to include and the service revenue. So what do I do to make it go away?
Debit service revenue and credit bonus
Receivable, exactly. So we'll do service revenue to make it go away for
2,500.
Oh yeah, I was looking for where did I write the number down? And the receivable for 2,500. So now what we have on our books, is we have no more accounts receivable. We have service revenue on our balance sheet, on our income statement of how much? What's our total revenue that we're recognizing?
Oh, hell, hang on a second.
Okay, so first we recognize service revenue of 10,000, right?
It's service revenue 17,500.
And then we recognize 17,500.
I can't see that without my glasses.
Okay. Have you enlarged your screen?
It's not you. It's just my laptop's small.
Okay. All right, so that's why you can't add it up. And then we're not counting the 2,500. So 15 and 10 is 25. Do we just do the whole problem?
We did.
All right, do you feel better about it now?
I don't know who was stuck. Catherine was stuck.
Catherine was stuck.
Yeah, that
Catherine,
was me. It makes sense now. Thank you.
Okay. Okay, we sell big screen TV packages consisting of 60-inch plasma TVs, a universal remote, and on-site installation. What I love about these problems is you can relate to them because we've all done these transactions. The installation includes programming the remote to have the TV interface with other parts of the customer's home entertainment system. The VP sells a 60-inch TV separately for $1,700, sells a remote separately for $100, and the installation service separately for $200. The entire package sells for $1,900. This should sound very familiar to you. So if we sold them all at full price, we have 60-inch TV for $1,700. The remote for $100, installation for $200. So there's our $1,900.
I figured out the
But we did.
of what it would be in relation to if it was 1,900 versus its total adding together.
Oh, okay. So if we did them all separately, it would cost $2,100. But the package is $1,900. So we're going to say what percentage of $1,700, what percentage of $2,100 is $1,700?
85.
And what percentage of $2,100 is 100?
5.
And what percentage of 200?
10.
And then I'm going to make sure that I have 100 added up here, which I do. All right, so now what I'm going to do is I'm going to say, all right, but we actually sold it for $1,900. So I'm going to take the package price and I'm going to say, okay, 1,900 times 0.85 is how much? 1615.
1615.
So that's the TV. And then the remote is 5% of the sale. So 19, yeah, 100 times 5.
I have
Is
a
how
question.
much?
Is 2,000 or is 2,100? Because if I know that it's going to be 2,000.
It's 2,000 instead of 2,100, but the percentages are right.
Okay.
Oh, did I added it wrong. Lovely. That's not a surprise to me right now. Not a surprise to me tonight.
That's okay. You're forgiven, you slave.
Okay.
Percentages are right, though.
That's good. Okay. So now when we look at the remote, it sells for a full price of $100, but we're selling the package for $1,900, so 5%. So the remote ends up being a value of $95. And then the installation is $200. So 1,900 times 10%
It's 190.
is 190. Yeah, I'm like, I can do that one. And that's the installation. So 1615, 95, and 190. So the TV is 1615. The remote is 95. And the installation is 190. Oh, cool, it totaled for me. And it's 1,900, which is what it should be. So literally all we're doing here is saying, if we did it as a lump purchase or if we did it separately, what's the value? That's all we're saying. Good here? I'll wait.
All about the percentages.
I'll just check my work while I'm waiting to make sure you understand.
Totally get it.
All right, number 3. How many performance obligations are in this contract? And then prepare the journal entry Gold Examiner would record on March 1st, March 30th, and April 1st. So on March 1st, I'm going to write down March 1st, Gold Examiner receives $147,000 from the local bank and promises to deliver 100 units of certified 1-ounce gold bars on a future date. The contract states that ownership passes to the bank when Gold Examiner delivers the product to Brinks, a third-party carrier. In addition, Gold Examiner has agreed to provide a replacement shipment at no additional cost if the product is lost in transit. Man, that's expensive. The standalone price of a gold bar is $1,440. And Gold Examiner estimates the standalone price of the replacement insurance service to be $60 per unit. And that's the insurance, right? Brinks picked up the gold bars from Gold Examiner on March 30th and delivered to the bank on April 1st. This is an interesting one. I've never thought about like gold delivery. All right, so the first thing we want to do is the number of performance obligations. So how many performance obligations are there?
2.
2, I agree.
And you should think about gold. Diversify, honey.
I know, right? Well, I hang it around my neck. I don't have gold bars. I would love to have gold bars, though. Gold bars would be good.
Should always have some gold and silver in your retirement.
You should. You're right. All right. The next thing we're going to do is prepare the journal entry Gold Examiner would record on March 1st, March 30th, and April 1st. Now, since we know that there's only 2 transaction dates, how many journal entries are we going to have? Now over here, if we only have
all 3.
Well, if there's only 2 performance obligations, are we going to have 3 journal entries? So let's see, what happens on March 1st? On March 1st, Gold Examiner receives $147,000 from a local bank and promises to deliver 100 units of certified 1-ounce gold. So what's the $147,000?
Cash.
Does it stand alone?
That's what they're getting paid. Gold Examiner is paid $147,000 from a bank who's a customer to deliver 100 units of gold bars on a future date.
Mhm.
So we're the bank, we hire this company, or in this case, we're the company. The bank hires us to go and deliver 100 units of bars, gold bars. Not today, in the future. And they write us a check for $147,000. See, it all goes back to that first thing, what happened? Once you understand what happened, it's not complicated.
Cash 147.
Cash 147.
Service revenue.
Defer.
Deferred, exactly.
Right.
Because have we earned it yet?
Not yet.
Not yet. So we got cash of 147,000 because we're going to deliver the bars later. And we have deferred revenue, which we used to call unearned revenue. Of 147,000.
It's not 147 on that first one because you're not taking into account the insurance.
Oh, the insurance.
That's your secondary. So the
Before the
gold
receipt.
bars is going to be a certain
Wait.
percentage, which you have.
We didn't pay the insurance yet. This is just
And-
report the receipt of cash. Oh, did they buy the insurance also?
Yes, they did.
Oh, okay. So the bank bought the insurance at $60 per unit.
Per unit.
So
Yes.
$60.
So your gold bars is going to be 141, 120, and your insurance is 5880.
Oh, because it's all included in the 147,000.
Yes.
So they paid us 147,000 for the delivery and the
So your title's correct. You had gold bars right.
yeah.
It's the
But I
number.
have 147,000 minus $60.
141, 120 on gold bars, and the deferred revenue for insurance is 5880. And it's the same type of percentage thing that we did on the last one because
Yep.
the gold bars ends up 96%, the insurance ends up 4%, and that's how you get the totals.
Oh, because a standalone. Okay, so in other words, we got paid $147,000. Well, yeah, we got paid $147,000 to do 100 bars. But normally each bar would be $14.40, and the insurance would be $60. Oh, I see. I see what we're doing. Now I understand the question. So what we have here is we got paid a total of $147,000. Normally, it would be, the gold bars are 1,440 plus the, we're not calling it insurance. Yeah, there we go. Of $60. So that's 1,500 times, how many did times 100? So our normal full price would be 15,000. So does that make sense? Are we good so far?
Yes.
Okay, so of that 15,000, we're going to figure out what each percentage is. So we're using this 1,500. So 14,440 divided by 1,500 is what percent?
Should be 96.
96%.
96%.
And the 60 is what? Almost nothing.
4%.
Right, obviously. Should have thought of that. Okay, so we get paid $147,000 instead of $15,000. Okay, help me, I'm tired. It's 10:56. So we're going to record the cash. We still have cash of $147,000 though. Why did you say that's $141,120? Because we still receive cash of 147,000, right?
That's what I thought.
So cash would still be 147,000. Does that make sense? Because that's what we were given. And then our deferred revenue for our gold bars,
141,120.
141,120.
Mhm.
What? 141,120. And then we have the insurance. Deferred revenue insurance.
Sorry, my freaking thing's stuck.
That's okay, my brain's stuck.
5880 for insurance.
Thank you. I had that number written down somewhere on the page over. All right, so now what we have is we have, and this is a really good place to use T account. So like, I'm not writing on the screen, but I'm writing deferred revenue, gold, 141,120, and deferred revenue insurance, 5,800, 5,880. I can't write it on the screen because I'm going to switch. Okay, so record any necessary entry when Brinks has picked up the gold bars from Gold Examiner. When they pick up the gold bars, have they earned anything?
Yes,
How come?
because the service was completed.
Is picking up the bars completing the service, or is delivering the bars completing the service?
Delivering.
Delivery.
Delivering. It's like if I have a delivering service come here to pick up an envelope, and they pick it up from me, they haven't earned the money yet. They've earned the money when they deliver that envelope to whoever they're supposed to take it to, right?
Yes.
So are we going to record an entry here?
No,
Deferred revenue and sales revenue.
But have we earned any sales revenue by picking up the gold bars?
no journal entry required.
Right. Am I supposed to do
Actually,
anything?
the way that the homework assignment goes, disingenuous on the way that they actually said it.
Brinks picked up the gold bars and delivered to the bank on April 1st. They are having you recognize the revenue on March 30th?
They are. I wonder if it's just because the way that of the product.
No, it's because it says the contract states that ownership passes to the bank when Gold Examiner delivers products to Brinks.
Oh,
There you go.
oh, I see. The contract states that ownership passes to the bank when Gold Examiner delivers the products to Brinks. Okay, so that means we're going to recognize the revenue now and not on the third one.
Basically SOB or FOB shipping point.
Right, exactly. So we have revenue of 141, 120. See, plus 5880.
Well, we're not doing the insurance. We're only doing the
Oh,
bars.
that's right, the gold bars. So 141, 120. So we're going to recognize revenue.
Deferred revenue for debit and sales revenue is credit.
Deferred revenue on gold bars
Yes.
is
141,120.
oh, I have it written down on my paper. And revenue. Now there couldn't be more accounts here. Service revenue.
Sales revenue.
See, it shouldn't be sales revenue.
Well, gold bars are an actual product, so
But we're delivering them. We're not buying them. We're delivering them. We're not selling them.
Service?
I'd still see it as sales.
Yeah, sales revenue worked. I wonder if service revenue works.
I don't know that it would be.
See, we're not buying the bars. We're just taking them and delivering them.
I don't know. It's weird the way that I've seen it on the way that some companies do it. is even if you're not the person that creates it, makes it, or you got it because it's a physical thing versus an actual service thing, like I did customer service for you, I've always seen it as they're very picky on dropping that under sales versus service.
Okay. In the real world, you don't really differentiate with service revenue anyway.
No, because it's all revenue.
But in the textbook, it's typically done. Record any necessary entry upon the delivery of the gold bars to the bank. Okay, what are we going to do with the gold bars to the bank?
That's your insurance and service revenue.
So now we're going to do deferred insurance, which is $58.80. And we'll recognize insurance revenue, I hope.
Service revenue.
Service. Oh, interesting.
Which is, they're really weird on, they're so picky.
That is weird. That's weird.
That was the only thing that I could put in my mind that's.
No, you're right. That's weird though. I mean, we completely understand what's happening and that's weird. All right.
It doesn't work like that.
I think it's not insurance revenue because they're not paying for insurance.
Oh, that could be. Okay, so this one works the same way. So how do you feel about what we've done already?
Good.
Okay. All right, so there's no quiz this week. We're going to finish revenue on Thursday, answer any questions about the paper, and then the paper is due instead of the quiz.
Bless you for that.
That's not my thing. I didn't design it. I am, however, designing the one that starts in January, but I did not design this one.
You can totally take credit.
Who did it? Yes. It doesn't look.
I don't know. I'll have to ask.
It's a little complicated too.
I'd have to ask Dr. Leitner. Well, they're all kind of set up the same way, and the problems go straight from the book, but the course is going to stay relatively the same structure without being required to attend the live chats. Actually, that's not true. There'll be more videos integrated, and we'll still have the live chats because, well, I think they're valuable. Okay, so I will see you on Thursday. If you have questions, you're welcome to call me.
I will.
Other than that, that's okay. We'll finish it on Thursday, and I'm going to go extend that due date for you too.
Thank you, Professor. Have a wonderful evening.
You are welcome. You too.
Thank you.
I'll see you Thursday.
Goodbye. Bye.
Good night.